Started in a few minutes. So welcome, everybody. We have a hybrid session today, which means that we have 4 panelists here with us in the room, and then we have 2, eventually, that'll be on the screen. So for those of you that know Futurama, they'll be like those little heads in the jars on the screen. And there they are. So welcome to Sacramento. It's a beautiful day. It's even better to see you all in person. My name is Lauren Maddock, and welcome to our lender panel. So for those of you that have been to Housing California in the past, this is something that the California Housing Partnership, the organization that I work for, traditionally does. It's a roundtable discussion, so there's not going to be any PowerPoints or charts or graphs or any of that. We are going to hear from our panelists what the current trends are in multifamily lending today. I am going to let them do self-introductions. I'll take it from here and say, my name's Lauren Maddock, California Housing Partnership. I'm a financial consultant, and I work with many of you in the audience today. I'd also like to welcome the people that are attending the conference virtually. We haven't forgotten about you. For those of you that are virtual, please type your questions into the Q&A chat box, and they will be fed to me, and I can ask the panelists. So without further ado, I would like to start introductions with our virtual attendees. Kenji, would you like to introduce yourself?
Yes. First of all, I just want to make sure everyone can hear me okay? Yes? Okay, great. So my name is Kenji Tamaoki. I work for a company called PGIM Real Estate. I'm based in San Francisco. We primarily provide permanent financing through Fannie, Freddie, and FHA, and I'm happy to be part of this panel. Thank you.
Thank you so much, Kenji. Eric?
Great. Hi, everybody. My name is Eric Kleinbach, and I'm with Wells Fargo. And we are one of the nationwide in California largest investors in LIHTC tax credits, as well as providers of construction and permanent loan debt. We provide, based on this panel, we provide construction loan debt, permanent loan debt, as well as Fannie, Freddie, and FHA financing.
Thank you, Eric. And to the in-room panelists, Josh?
Was harder than it looked. Hi, my name is Josh Hamilton. I'm with Century Housing. We're a nonprofit CDFI lender based in Culver City with an office in the Bay Area. We primarily provide acquisition and bridge financing for developers to acquire land and hold it and give them time to put together the financing they need to build the affordable housing. So that's primarily what we do. We also are doing a lot more permanent loans as well for 9% transactions, as well as for other affordable housing projects. And we do some construction lending too. So that's me.
Hi, everybody. I'm Cécile Chalifou. I'm the head of community development banking for the West for JP Morgan Chase. I'm based in LA, but I cover the whole West. We do only debt in my group, construction and permanent financing for anything from permanent supportive housing to missing middle. It's actually quite a variety of transactions. We do not do equity ourselves, but we have a group within the firm, obviously, who is very active on upper tier investment. And we also do some Fannie lending and very soon Freddie.
All right. I'm not going to take it off.
No,
Okay.
don't.
All right.
That's better.
Great. And I'm Lisa Gutierrez from U.S. Bank. I've been with the bank for 16 years. I manage our debt originations platform for the affordable housing group nationwide, as well as our multi-fund investments with tax credit syndicators. And I am based here in Sacramento, so welcome to Sacramento.
Hi, everyone. My name is Elizabeth Van Benschoten, and I'm with Union Bank's Community Development Finance Group. I think you heard my colleague Parika Bell speak during the after-lunch plenary. I've got some other colleagues here in the office. I manage our lending and investing team in Northern California, and my colleague Brian Roberts covers Southern California, if you've met him. We do construction financing. We also do permanent financing. We do have access to agency products through CBRE Affordable, but we primarily will use our own balance sheet, and we can talk about that later. But we also provide equity financing, so we'll do direct equity investing alongside construction lending.
Great, thank you so much. So how is this going to work? We're doing a roundtable style discussion. We'll start off with construction financing, then we'll move into permanent financing, and then we have a list of what we call hot topics that are pertinent to, I hope, all of you in the room. So to start it off with the construction roundtable, I'm going to actually go backwards and start with Elizabeth. So in our construction roundtable, we're going to be discussing interest rates, spreads for both taxable and tax exempt.
I have to go first?
Yes. Interest reserve sizing in the current rate environment. If you're willing to talk about any hedge, I'm sure that's always sort of elusive topic. And then appetite and fund availability. So any of those, if you'd like to start off the discussion.
Yeah, sure. So in terms of construction pricing, I think everyone knows we've been shifting away from LIBOR, so we're now quoting all of our construction loans off of the SOFR index. I'll just put out there that I think the spreads that we're seeing could be 150 to 175. It really kind of depends on the deal, the size of the deal on the construction side. Hedging, when you're thinking about, interest reserve sizing, when we're looking at how to size an interest reserve, we're typically asking people to put in basically 100 basis points as a cushion unless they're going to be able to have a swap in place or some sort of hedging product during the construction period. Our bank actually has quite a good ability to provide hedging products in terms of caps and swaps. I would say, though, in this environment right now, they are not the most economical products, so a lot of our clients have not been choosing them. We certainly can offer clients that option. I would say, maybe a year ago, putting in a hedge, a swap on a construction rate was something that we would do more frequently with a client, but we're not doing it as much right now. I think that those are the main things. Capital availability. Oh, and capital availability. So we are open for business, and we are we're definitely interested in talking to folks about their deals. I think one of the recurring themes I've heard throughout the conference is just sort of staff capacity across the board. We're certainly looking for the right deal. I think one thing that distinguishes Union Bank, perhaps from my colleagues on the panel, is that we are not as large of a commercial bank. We are a California-based bank. Much more regionally focused. We've been able to really offer clients high customer service, kind of more boutique fits to their projects. So from that standpoint, I think we're a really good fit for a project that might be, $25 to $30 million in construction loan size. So as you're talking to different lenders and trying to figure out people's capacity and where best to take your deals, there might be a better slot for us versus if you're going to a lender who's looking to do, an $80 million construction loan, for instance.
Great. And here at U.S. Bank, obviously we're an active construction lender. I know we go down the line here with our interest rates and where we're at. I would say we also are pricing off of the secured overnight funding rate, term SOFR. And up until currently, we've been including a floor on that, but we are seeing that the secured overnight funding rate is continuing to go up. So those floors are not meaning as much in the market. We're probably about 195 to 225 on spread and fee and origination fees, from 50 basis points to 100 basis points, depending on the size and scope of your transaction. From a capital kind of capacity, I would say I echo the sentiments of what you're going to hear today. I know that human capacity is coming into play just with the changing of the deadlines that are happening with CIDLAC and TCAC and kind of compacting those. So rest assured your lending community is working on that and hopefully trying to figure that out with the state and officials. But we do 40% of our business at U.S. Bank in California. It is a major market for us. We are committed to this market, not just for CRA purposes, because it makes good business sense as well. And we're committed to the community. So capital availability, as long as we have the individuals to close business, we will continue to bring in new business. And I would be remiss to say, we do have, complementary work with our direct investment group. So I handle the multi-fund investments on my side, and we do business with syndicators, but we do a fair amount of our business joint with our equity partners as well.
All right, so let's talk about us in terms of first the rate. Very similar theme, obviously. Just a couple of points here. We've switched to SOFR, obviously, a few months back as well. On floors, it has been really interesting because a lot of us put some floor last year, 2 years ago, actually, almost 2 years ago, because rates got, the index got so crazy, we realized we cannot be like in the red literally from day one at the time we close, right? But of course, those floors are becoming less relevant, and I think that's, we all at peace with that, and nobody's talking about raising floors, but definitely 2 years ago, it got a little bit nerve-wracking. In terms of, a lot of people are asking whether the spreads are going to absorb some of the rise on the index. I think we all know, unfortunately, that's not how it works. Index are going to rise, keep rising. That's everybody's expectation, but the spread don't necessarily go lower because the spread is literally the only piece of profit we get, right? Mm-hmm. So, unfortunately, we're all bracing up for both on construction and perm later when we discuss that for an increase in rate, and I don't think anybody can do much about that. Lots of pressure on interest reserve and being careful, for sure, but that's kind of the trend. And I think to a certain point, I remember like 3 years ago at this same conference, we were talking about that, and then it didn't really happen, so people forgot. But we were telling people to be careful that we were anticipating a raise. We just got a few years of reprieve, if nothing else. But I'm sure we're kind of all on the same page on that. And it's still in California a very competitive environment on spreads and on pricing. So the developers are quite lucky here compared to some other states. We're all very aggressive on our goals as banks. In all good spirit, all good spirit. All right. And in terms of capital availability, I mean, for JP Morgan Chase, actually, we did make a big commitment to affordable housing. That does mean in the West in particular, what we do is not driven by CRA. And we have shown it by pretty much doing, the very large deal. We can do $170 million on our own. In New York, we did 2 at like $300 million on our own. We're one of the only banks who can do virtually any construction loan without participation. But I want to make it clear, we're not just focusing on the big ones. So actually, we did some very small ones. They're not great from an economic perspective, but that's part of our commitment. So I'll give you an example. We did one deal, I won't say in which city, but like in a city that had never done permanent supportive housing. There were 13 public lenders, and they needed a 1.5 million construction loan. I'll tell you, on that kind of loan, you're losing money the moment you open the email, right? Like, you spend 5 minutes on the thing, it's already in the red, go for it. But we, and my team is absolutely so dedicated, they say, we have to do these loans. And I'm a sucker, so we said, yes, I'm kidding. But literally, our commitment has been not just to do the big one. I know it sounds great, right, when we say we can do the big ones, but we really pay attention to doing a whole lot of other deals. So we've done a ton of rural deals over the last 2 years. We have done a lot in Fresno, in the Central Valley. We're really committed to really doing it everywhere where we can. We do not have a capital constraint. I made it clear for now. That could change, right? We do know the financial world goes through some hopes at some point, but at this point, we are in a very good position from that perspective. So I don't see any limit. We can do our own perm on balance sheet. We don't have any limit on that either. So it's a pretty good situation, but I would say we also, collaborate very well with all our friends here. And as Lisa said, we're spending a whole lot of time, I'm spending a lot of my time on work on trying to make some programs work better. You're right, on CDLAC and TCAC, we're going to get that done, right? Aligning deadline, because capacity is a big problem. It is a big problem, and I would say if there's any concern for us, it's the fact that On the banks, on the developer side, on the public agency side, everybody's stretched very thin, which means everybody's closing deals going a whole lot faster than they used to, and it's a little bit nerve-wracking as an industry. So honestly, on construction financing, a lot of attention on capacity. It's not a detail. No.
Great, thank you. Josh, do you have anything to add?
Well, I don't actually do a lot of construction financing in the affordable housing space. So
And just remember to speak into the microphone, all of you, so that the virtual attendees can hear. But I am going to ask Eric, because I know that you do construction lending.
Yeah, of course. Not to rehash too much of what folks are doing, we're pricing off of SOFR. A couple years ago, we instituted floors as well. Those floors are coming down. Generally speaking, they're in the 50 basis point range. Spreads are kind of anywhere from 150 to 200 to maybe 215. Again, those are coming down. I think a lot of that is in a reaction to COVID and the pandemic, I guess, stabilizing, or whatever stasis we're in right now. It seems less acute than it was a few years ago. So generally speaking, pricing is coming down a little bit. Obviously base indices are going up, as folks have mentioned. We do have a platform for interest rate hedges, swaps, caps. Generally speaking, they were a great investment year and a half ago, and generally harder to pencil right now. Maybe unless you're forecasting some really heavy interest rate risk, which we all have our separate crystal balls. So look into yours. And capital availability, we have a large appetite from small loans to very big loans. Really looking to support our customers and getting shovels in the ground in big communities like Sacramento, LA, San Francisco, to smaller communities throughout the Central Valley or in the Northern California region. So happy to support anybody where you do business. I think that's it for the construction side.
Great, thank you so much, Eric. So I do want to encourage, if there's questions in the audience, raise your hand. We'll pause and be able to answer some of those for you. And then also for those of you virtually, typing your questions into the Q&A box, and those will be fed to me here in the room. I do know there was a question virtually if we're going to cover the Hcd Accelerator Program. The answer is yes. That is part of the short topic list, so we will be discussing that in a little bit, so be patient. But in the meantime, I'm going to switch over to permanent lending and give Kenji an opportunity to start covering balance sheets versus third-party options offered by your bank. And Kenji, I also know that you are eager to talk about the Fannie, Freddie, and FHA trends as well.
Great, thanks. So PGIM, we offer basically the whole variety of permanent financing products, life insurance, third-party funds management, balance sheet. But I'm actually going to focus primarily on Fannie, Freddie, and FHA because that's where we do most of our affordable lending. And in terms of the trends, I think the one thing that I really want to mention is how much Fannie, Freddie, and FHA have been focused on affordable. It's always been part of their lending mission, obviously, but especially with Fannie and Freddie, the Federal Housing Finance Agency, which oversees them, set their 2022 affordable lending goals. This is an amazing number, 40% higher than 2021. Their volume goal for each agency went from 14 billion in 2021 to 19.5 billion in 2022. And at 19.5 billion, that's actually 25% of their total annual loan production. So pretty much every conversation we have with Fannie and Freddie is how they are going to meet that goal and how they are going to ramp up their programs to accommodate that. And from the perspective of the developers and the owners and the tenant advocates in the audience, the benefit that you will see is in the form of lower interest rates, more aggressive terms, lower debt service, all of those things that are important to making affordable housing deals work. And a couple of things I want to mention. One is that affordable housing by Fannie and Freddie's definition and the FHFA's definition actually isn't tied to a regulatory agreement. What it is it's measured by how much rent the tenants are actually paying. So when we close a deal, we look at a rent roll and calculate how much each tenant actually pays and compare that to the local AMIs. So in most markets, a unit counts as affordable if the tenant is paying a rent or the tenant's share of the rent is 60% AMI or less. But in higher cost markets like San Francisco, it could be 100% AMI. And in some even higher cost markets, it's 120% AMI. So if I know most of us focus on tax credit deals, but if you are looking at, say a naturally occurring affordable deal where the rents are just between 60 and 120% AMI, and there's no regulatory agreement, it's worth checking whether that might still be eligible for the discounted pricing or more aggressive loan terms that would normally be reserved for those tax credit deals. And another example might be where you have a property that, again, has no regulatory restrictions, but just has a really high percentage of tenants with tenant-based vouchers. Because we are looking at how much the tenants are paying, that deal might actually be very appealing to Fannie or Freddie because it could qualify as an affordable deal, even if there are no restrictions. So those kind of deals are case by case. So it's not always easy to make the call just in general, but if you have something like that, then it's definitely worth talking to a lender and seeing what kind of terms you can get. Another couple of things I want to talk about is how Fannie and Freddie are kind of in some ways moving beyond just being about affordable lending. Like, for example, one of the things that Freddie Mac just rolled out is something called a diverse borrower certification. And it's basically a volunteer survey in which borrowers can provide information about themselves, such as if they are a veteran-owned or minority-owned business. And it's really the first step in Freddie Mac trying to understand how their whole business model is really working and if they're reaching all eligible borrowers. So I participated in a lender training just a few days ago, and they emphasized how much thought they've put into this program, and also how important they understand they need to protect this information. Unfortunately, in the past, some of the same information has been used to negatively affect some of these groups by now trying to collect this information and understanding what sort of residual effects are still out there. They're trying to understand what can they do differently? What are they succeeding at? What are they doing differently? And they're collecting this information. For example, Freddie, the borrower submits this information directly to Freddie. Companies like PGIM won't have access to it. But I'm really looking forward to seeing what kind of new programs they might introduce once they start to collect this data and understand, what sort of issues they discover. And the last sort of non-lending but affordable supportive program that I want to mention is a new pilot program introduced by Fannie, which they're calling Expanded Housing Choices. And unfortunately, we hear a lot of stories about how tenants with Section 8 vouchers are unable to find landlords who will accept them. And I don't think I'm preaching to the choir here. I don't think that this is an issue for anyone in this audience. Obviously we are trying to support exactly those type of tenants, but there's a lot of landlords, unfortunately, who don't feel the same way, and Fannie recognizes that, and so they created this expanding housing choice vouchers where they're basically going to provide an interest rate discount to owners who commit to accept tenants with vouchers. And right now it's just rolling out in North Carolina and Texas. Those are two states where the law does not specifically prohibit discriminating against tenants with vouchers. But I think, this is sort of a very creative thing trying to address a disparity in the market. And I like to see Fannie and Freddie coming up with new programs like this to support the larger affordable mission.
Great, thank you so much, Kenji. That last program that you spoke about is fascinating, and hopefully it'll expand to other jurisdictions across the United States. It sounds like it could be incredibly useful, particularly for the affordable households that want that choice of where to live. I am going to turn back around to Josh to talk about some of your perm loan products, I also wanted to give you an opportunity. You're one of the only lenders we have here that offer acquisition financing, and then also potentially smaller loans. So if you want to talk about that.
Sure. I'm happy to talk about our permanent loans and maybe circle back to the acquisition loans. Yeah, Century Housing, I think we're unique. We're a unique lender in a lot of different respects. And so, as I mentioned in my introduction, we're a CDFI, we're a nonprofit. We are looking at opportunities in like a traditional lender in many ways, but also with a slightly different lens in some respects in terms of how we broaden the market, how we reach specific types of developers, and the kind of deals that we look at. And so, in terms of our permanent loans, we have traditionally, through the history of Century, only done short-term acquisition and bridge financing. And we have, that's kind of our unique, value add to the community here in California. There's not a lot of other lenders who are doing acquisition loans on land. And so, but the downside of that is you need to these are short-term loans that you need to constantly replenish. And so we've moved more into the permanent financing space because we saw a need there. And, just in terms of our balance sheet, it made sense to have a certain percentage of our loans not get repaid every 12 to 18 months. And so Century went out and we were able to, because we got a credit rating through S&P, a very strong credit rating through S&P, we were able to leverage our balance sheet and take down some longer term debt from third parties that we were able to lend out for permanent loans. And so we only provide taxable loans, and we're not in the tax exempt space yet. But because Fannie and Freddie and HUD, are such dominant players in the permanent financing space, for the loans that are funding immediately, not the 9% forward commitments, but the immediately funded loans, we've really found it's probably easier to not try to compete head to head with Fannie and Freddie because they just have a great product and they do a very good job in addressing that market just fine. We're looking, at Century, being a CDFI, we are looking at some smaller deals. We're looking at some deals that may not be a perfect fit for the agencies. Some of them need to be repositioned or need better management. They want some seasoning. One really kind of unique feature of our permanent loan is that we're balance sheet lenders. And that's very different than the agencies who securitize their permanent loans. So because we're lending cash that we have on our balance sheet, we have a tremendous amount of flexibility in how we structure that financing. So one of the key differences is that we have a lot of flexibility in terms of our prepayment penalties. So what we're seeing are some, we're not securitizing those loans. So there's not a bond investor that needs to be made whole if those loans are paid early. There's no yield maintenance. So what we do is we work with our borrowers to say, okay, you need 10-year fixed rate debt. I need to have an interest rate that is in the ballpark. I can't, I need to be competitive at a certain level. But what happens if, the volume cap is increased in 3 to 5 years from now? You're going to want to ultimately re-syndicate this deal. And so we can give a lot of flexibility during that 10-year period of time to allow the developers to take advantage of market conditions that if they're able to re-syndicate and do a new tax credit execution, they can do so without a significant breakage penalty. So that's one value add that we embed into our loan product. We don't have to do it that way. We could hold a firmer line if we wanted to and have a higher prepay penalty or have some kind of yield maintenance penalty. We think it's important, though, to do what's best for the community and to allow them to re-syndicate those deals when the time is right. And so that's one thing that, one kind of key difference. And then besides just the immediately funded loans, we are doing quite a few 9% forwards. So we have a pretty healthy pipeline now of permanent loans that we are providing 24 or 36-month forward commitments. Those interest rates are competitive with any, we're able to be competitive in that space in terms of interest rate. And because we're balance sheet lenders, we're able to offer the same kind of flexible prepayment terms. And, one thing we have done as well is we've agreed to hold the interest rate during the underwriting period because we have the funds in hand. And with rates moving the way that they have, my CFO can look at me and say, well, we could have made a little bit more. But the fact is that we made a spread that we needed to make to be profitable. And with rates rising, we didn't have to increase rates for the pure profit motivation of increasing interest rates during that rising interest rate environment. So, that's one thing that we've done on the 9% deals. And do I have a little more time? Or do you want me to cut it off there?
I think we're going to have to move on.
Okay, that's what I figured.
That's okay. People were really fascinated. I was fascinated. And there'll be more time. But Eric, you were on the agenda to potentially speak about perm a little bit. And then Elizabeth, maybe you wanted to chime in about amortization underwriting considerations at the very end of our perm section. So, Eric, is there anything you wanted to add?
I'll be quick. At the top, I mentioned that we do a lot of permanent loan financing through Fannie and Freddie and FHA. I did just want to kind of mention to folks that we do have a tax exempt and taxable on balance sheet perm product. Notably wanted to mention we've kind of refined our underwriting standards on the tax exempt on balance sheet perm. And generally, it's an underwriting box that historically was maybe more competitive in nationwide markets and less competitive in markets like California, where pricing is very aggressive. And I think that's to the benefit to the overall community. And so we've been able to kind of work with our internal teams, and we're currently using a 115 debt service coverage ratio, 35 or 40-year amortization. And I think the 40-year amortization is something that we look at warily. We want it to be in an urban market. We want it to fit the project. So I think it takes a little bit more underwriting and eyeballs on it, but it's a product that, because it is on balance sheet and kind of echoing some of the things that I think Cecile mentioned, as well as Josh, there's a lot of flexibility when you have an on balance sheet product like that. And we're looking to bring that to bear in our underwriting.
Great, thank you, Eric. Elizabeth, is there anything on the perm side that you wanted to finish with?
I think one thing I should mention is that so Union Bank does offer a perm loan product, and we use our balance sheet for it. The thing that distinguishes us from, I think, every single person on this panel is that the way that we're doing the rate lock is that we're having the borrower enter into an interest rate product. So your perm loan documents would have a floating rate tied to them, and then you would enter into a hedge, such as a swap, to fix that rate. Now, the end result is that you tend to get a very competitive rate, sometimes more competitive than I've seen in some of the other fixed rate environments. But for folks who haven't worked with swaps before, I think it's just important to mention that. I've noticed that more of the development community at this point is pretty familiar with them, but it's something that we like to call out and to talk to people about beforehand. And one thing I think it's just worth repeating is this concept of break funding. I know, I know that the GSE products have tried to create some flexibility. Kenji usually has some interesting solutions about different windows of time for break funding that he can talk about. It sounded like Josh was saying that there would not be a break funding event. I know for our perm loan product, there would be a point in time where if you were to prepay early, not prepay, but if the loan was to sort of go into default, you would basically break the rate that you had locked. And so that would trigger an impact. Now, the interesting thing is with the swap, you could be in or out of the money depending on where the market is, whereas a conventional commercial bank product where they're using a bigger hedging, we're doing individual hedges on each deal, but a bigger commercial bank has a whole hedging shop, and so they might be able to bundle those hedges. And so they may not offer the opportunity to be in or out of the money when there's a break funding event. So that's just something to think about if you're a real interest rate wonk and when I get into that. But it's also important to just know that that's a real risk for projects and to think about. You had asked me about amortizations. One of the things that we've been able to offer is a 40-year amortization. I think other people have kind of come back. That had been more popular, and then I think around the Great Recession that had kind of pulled back, and now it's coming back around. Eric mentioned that they'll look at those deals on a case-by-case basis. I would just say that when we look at a 40-year amortization product, we're really thinking about the back-end refinance risk. So wanting to understand what's that balloon payment that you could be left with? Can this project really support a refinance? So we'll make some assumptions on the future rate. That's kind of hard. You're saying, okay, 18 years from now, where would rates be? So you kind of take an inflated perspective on where you think the rates could be to see, could you refinance this debt? So we're looking at things like that when we offer a 40-year amortization. But that's the thing I would just add in terms of underwriting for
Yeah,
amortization.
we're seeing that as well, that some projects really need that longer period just to really pencil and to not necessarily chew into a developer fee too much, particularly with the interest rates rising. I do want to give kudos. There was a question that was submitted early. I don't know who submitted it, but I want to recognize the fact that they used the Hoover app, okay, those of you that haven't downloaded it. And the question was, I wonder if there are any unique underwriting criteria to assist small rural projects or lenders who are willing to work with small organizations or small projects. Do any of you want to address that?
Okay.
Looks like Cecile.
That's actually an excellent question, and we've done quite a few. I would say a couple of things. In terms of the project themselves, small, obviously, every bank has different, threshold on what they want to do, but I want to say, as I said earlier, we have done some small ones. Those deals are hard, right? We know, we spend a whole lot of time on operating subsidies, really understanding who the target population in rural, whether it's only farm workers, a little bit bigger group, how, the question of being legally in U.S. Plays in terms of subsidies and all this good thing. As long as the developer can make a good case for how they're approaching it, we have been able to underwrite everything. Working with USDA, wow. That's all I can say. We thought HUD had the prize for being difficult. We love HUD, as somebody said this morning. We do, but USDA kind of beats everybody. That's for sure. It has been really challenging, I have to say, and we know that on some of the deadline with bonds and credit, we saw it, right? They got exemption to close later this year. Pretty incredible, but we have been able to make it work. It has been really interesting working with perm lenders like Bonneville and really trying to be creative around whether or not they could lock the rate on perm. So actually on rural, there's quite a lot of creativity and being willing to look outside the box, I have to say. In terms of the smaller developers, well, we all know the challenge there, but we have been able to work with some, including not just in rural, actually in other regions, like newer developers, BIPOC developers. What I would say, the way we have been able to make it work is to not just focus on the developer themselves and their experience and financial capacity, but really looking at the whole team. In other words, is there public money in the deal, from a city, somebody who can step up and help if needed? Are they working with an investor who we know will stick by them if things go wrong? So we're a little bit pickier about who they pick as an investor. And, we will not disclose any name, but we all know everybody, right? So we're really paying attention to who they're inviting. Legal team, and obviously the consulting team. That's not a pitch for CHP or community economics, but it makes a whole lot of a difference to work with a smaller developer who has lined up all the right people. Because if nothing else, it means that they did their due diligence, their homework, to figure out how to assemble the best team. So it's absolutely possible to work with smaller developers. Again, I'm sure every bank has different appetite for those. We've done it, but again, it takes a little bit more work, but it's absolutely possible, and we have shown it made by actually doing the deals.
Great. And Lisa, do you have something to add?
Yeah, I would say, and from smaller developers or rural communities, you usually find that those developers really understand their markets. So that is something I think that's key that shouldn't be discounted when looking and assessing those deals, and that's something that we take a look at. It's not really necessarily the size of the developer and their balance sheet. Obviously, those things are important, but also their network in that community, how they know their market, what other projects they've developed in that market. They actually have history that comparable history that we don't have that they can provide. So I think it's valuable.
Yeah, I agree. Yeah, definitely. And
I just wanted to add one thing, which is I'm not sure how small of a deal size they're thinking of, but I think also sometimes what you hear at these conferences are people who are working in the larger complex of multifamily affordable housing, and that when you're getting into one-off projects or smaller projects, maybe projects that don't even involve LIHTC, sometimes it might be a better fit within the commercial banking arm, like a business banking section of a bank or a regional bank that's serving that community, or a CDFI. I know CDFIs typically don't do as much construction risk, but I think, just to kind of widen the lens of who you can talk to.
yeah, I mean, that's absolutely true. I did work with a client who did exactly that. It was a small building in Santa Rosa. It's around 20 units, and they only needed about $1.5 million. And you're right, we ended up going to a local community bank, and they provided us with a product that worked well. So it's definitely possible. So keeping those connections alive. Okay, so I would like to, I think, jump in. I'm not seeing any questions online, and I'm not seeing any hands raised in the audience. So let's jump into some of our hot topics, because I want to make sure that we have time. We have about 45 minutes left on this panel, and I know in about 40 minutes I'm going to start losing some of you to the music and the courtyard, the drinks that are already happening out there. So, hot topic number one is, we're going to start with Eric and then go to Elizabeth. High cost issues, right? We've all been hearing about this. It does not affect just the affordable community. This affects all construction. I did construction in my backyard, and guess what? All of my cement was stuck on a ship in the Sacramento Channel while the ship was in quarantine for 3 weeks. Yes, so there's cost overruns and delays and material issues. That's happening right now. So, Eric, do you want to start talking about how you're dealing with that on the lending side?
Yeah, I'll kind of take a stab at part of this and let others jump in. But like you said, there are delays across the board from materials. I think there's also labor shortages, getting subs to bring enough skilled labor on site. Maybe they're bringing unskilled labor on site, which that's nice that you've got warm bodies on site, but their work, it just takes a lot longer for them to complete the same tasks. So, knowing what you're getting from your subs or your GC through your subs is important. Materials that are kind of hotly going up, or lumber and steel and epoxy, some of those have shortages. Like I said, labor has kind of been a story, I think, really for the last 5 to 10 years, as older workers have been starting to retire. And we just haven't been able to get a pipeline of younger talent in. An interesting conversation that I had with a contractor recently was projects that historically took 12 to 14 months now take around 18 months to build. And this is kind of an issue that I've run into, and I just wanted to highlight it to folks, is it's particularly an issue on 9% transactions. Take, for example, a project that's closing right now, 18 months from now, is going to be, the fourth quarter of 2023, which is your placed in service deadline. You've got 1 to 2 months of cushion before that placed in service deadline occurs, which, as we all know, is pretty much a cliff event. It could potentially invalidate all of your tax credits, which is a major issue. And part of what I wanted to say today is just, I think I view the readiness deadline and the placed in service deadlines as guide rails to ensure critical capital going to project ready projects or shovel ready projects, so that we can get residents in their homes as fast as possible. And it's not meant to, blow up a transaction or bring unnecessary risk to our project, from financial partners to sponsors to cities and counties that are putting in a lot of their important capital to work for their local citizens. So I think I just wanted to highlight that, from a construction timeline, this place and service deadline is kind of rearing its head right now. And it's something I think we should all be thoughtful of as we get feedback from the construction industry. Not only are costs going up and up and up, but timing is an issue. And we do a lot based on a rigid schedule. And I think a lot of times we all need those deadlines to close transactions, but sometimes we need some flexibility. And so I think, how do we solve that as an industry together is really important. I'll kind of leave it there, Elizabeth.
Yeah.
Yeah, so interestingly, when I was thinking about to say here, I wrote in all caps, the entire system is stressed. And I think that's really what you're hearing. It is, whether it's the materials, so on the supply side, the labor, whether it's on the ability of the different lenders, the state, to kind of come to the table in a timely fashion to handle the sheer volume of business that's coming out the door as we're trying to get so much money into the marketplace. It's creating lots of ripple problems. And so when you're looking at your deal, trying to think about how do I proactively think about what those problems could be and how can I manage for them. We anecdotally just closed a deal where a great project. It was one of those, I don't want to reference Macbeth, but it was one of these things where it was like, it just kept getting hit with all sorts of issues. One was that while the client had done a good job building in a cost escalator, we watched that get completely eaten when they finally got the costing back from their GC. And then we noticed that it even went up even further than they thought, because it happened to be a project that was happening in a disaster recovery area. And so what you're finding, especially in certain markets where you might have a very small pool of subcontractors, if we're throwing a lot of subsidy money into those markets, that now you have even greater demand for those subcontractors. And so that really sent the project costs through the roof more than they thought. This project also, as we were getting close to close and locking in the rate, the war in Ukraine started, and so we were watching interest rates rise, and it was an example of the strength of the developer, quite frankly. Like, they did everything. They looked at deferring developer fee. They looked at, were they going to have to possibly come out of pocket a little bit? It was really trying to solve as much as you could. And so I think that really underscores why when we talk about partnerships and relationships, they're so important, because there can be those situations where there is, you're going to hit some hard decision points, and are you in a position to say, yes, I can defer developer fee, But the key things that were mentioned again were in looking at this environment we're in, being realistic about how long your project is going to take. We will have our construction cost review folks come back and say, hey, they're saying they can build this in 18 months. We actually think that given all the delays in the marketplace, they're going to need 24 months for their project. And so that's a conversation that we'll have with developers. And so looking at your own schedule. Of course, a longer project means other things. It means an increased interest reserve, because now you've got this construction loan hanging out there for longer. So thinking about things like that, thinking about, hey, what's the Fed going to do? They just went up by 25. Well, that's the short-term rate. But like just looking at long-term rates and thinking about how those could move against you. So it's all these things are kind of tied in. And then lastly, I wanted to just mention actually two things: contingencies. So typically we'll all look to underwrite 5% as contingency, but more and more we're looking at projects more closely and saying, do we think that there might be some reason that you should have maybe a 6% contingency? Let's talk about this. The other thing is, when you have delays on the front end, you could have delays during the construction process, or maybe even just getting a party like Hcd to be able to come to the table in time. And so then you can have a delay on the conversion side. So really don't underestimate all these different pain points in the project, and think about giving yourselves a little bit of cushion so that you can try and avoid some of that stress, or so that when you're sitting across the table from your lender and you want to hammer them on some things, you can say, but look, I've given you X and Y, and these are the ways we're mitigating this risk. And that's kind of the back and forth interplay that you'll have.
Great. And Lisa, it looks like you want to add something, but I'm also interested to hear any cinch points around the 50% test. And are you seeing any pressure in developments with the escalating prices and projects that have maybe gone in for bonds at a 52% to be competitive, and now they have escalating prices. Is anybody seeing that? But also, I do want to give you the opportunity to respond.
I can see the conceptual problem, I can see the problem conceptually, but we have not run across that.
Okay.
And I think it's important to mention very simple concept, but communication. I know a lot of the development community are problem solvers. So when you get that initial sticker shock of your GC cost update and you see that there is a significant increase to that, kind of getting your lender and investor involved earlier rather than later, rather than waiting, trying to value engineer your project, and then keeping kind of, I wouldn't say your lenders, investors in the dark, but trying to handle it before bringing that issue. It's better, let's get it all out on the table, because there may be other solutions and other things that maybe we could be thinking about collectively. But I think we're seeing later and later costs being updated, and then having that, working on this like couple weeks before, 3 weeks before closing. If we can get to that sooner, I think that's probably our best bet.
Can I add something on that one, Laura?
I just wanted to check in. I noticed Eric had taken his microphone off. I don't want to forget about a remote panelist. Eric, did you have anything to add?
Yeah, no, I just wanted to say that I hadn't seen anything on the 50% issue that you brought up. But again, I'd conceptually say I could see that being a major issue. But I just kind of wanted to affirmatively say that.
Okay, and Cecile?
Yeah, actually, on the 50% test, I think we haven't seen it, but the developers have and have adjusted before coming to us, thankfully, which is the right way to go, by the way. That works very well. But what I wanted to say is, like, what we're seeing is more and more requests on increasing the perm loan to compensate for some of the increased costs. And to Lisa's point on that, it's much better to call your friendly lender in advance, because credit does not like those requests. They're all workable, but it takes some creativity, right? Because it actually puts some pressure on the deal. People say, "Oh yeah, but the rents have increased since 2 years ago when we underwrote this thing, or like almost 3, right?" That is true, but every pro forma is built with some cushion that comes from that disconnect, and we know that. So when we increase the perm at conversion, when we maximize it, that cushion is gone. Right? And if you look at it in a current environment, yes, the rents are a little bit better, but there is tremendous pressure on the operating expenses. And by the way, we can see that there are some developer bringing it on one deal, but then forgetting to say it on the other deal. Well, we don't forget, right? So like when people, credit never forgets, just let's be very clear. When you tell them utilities are going up, payroll are going up, insurance is going up, and we all see it, they're not going to forget the next day when you ask them about another deal where you're trying to make the case that you need a bigger perm, right? So there's definitely a whole lot of pressure on the NOI right now. So those conversations on increasing the perm are actually not simple. Plus there is the question of rate lock and all this good thing. So to Lisa's point, it's much better to bring it up early. What we see is people, they know they have the additional costs, the overruns, but they ask the question about an increased perm about like 3 months before conversion. Again, think credit very grouchy, not a good negotiation place. But so having that over time, we know it's coming, and trying to right size the perm based on that takes a whole lot of time. So anyway, something to think about. It's not just a construction issue, it is a perm issue.
Yep, nope, loud and clear. So it's like being in a relationship. You want to communicate ahead, and so you don't end up in lender therapy. Yes, okay, let's avoid lender therapy. So we're going to completely shift gears here. I know that technically on our list it says HCD funding issues, specifically the Hcd Accelerator Program, but I'm also going to expand it a little bit. Last week, HCD released a program which is near and dear to my heart as somebody who works on portfolio recapitalization work, the Preservation Program. And the concept on both the accelerator as well as the preservation program is HCD will come in with a very large amount of takeout. However, in both cases, they do not provide construction financing. They're not able to. They just simply can't. So we need lenders who are willing to come in and provide essentially all of the construction financing. There's no investors involved in the deal. And it's a big risk, right? And especially with the accelerator program, these are big loans. So how are you dealing with them?
Right, and I got stuck with that one. Thank you so much, Lauren. So,
She volunteered.
more or less. It was along the line of like, who has worked a lot with HCD over the last few months? Yay, lucky me. So in any case, HCD has been actually, to give them credit, they have been very creative, right? And we don't want that. The accelerator was an amazing option to use federal money that we know will be lost. And, there's really, we all know the needs, so that was a great thinking. I think what was more lagging is including all of us early on in the design, which would have made things a little bit easier. What Lauren is alluding to is actually quite important, and it was a little bit missed on some of the conversation originally. When you talk about high LTV loan, which those deals are, right? Like, it's a whole lot of HCD money because there is no investor. It's pretty basic math, right? You're talking about transaction where you can be like at 2,000% LTV. I have one of those. There's one where it's actually, our credit person call it like it's an infinity LTV. It's like there's no end. Which means technically, if things go wrong, you couldn't get repaid. What does that mean? It means if HCD doesn't fund that conversion, we won't have a major problem. So this is not about, saying it's a technical, we don't like it, right? It is actually a tremendous pressure on the construction lender to take a whole lot of risk. We are regulated institutions. There are rules on LTV for all our benefit, right? Banks own everybody's money, right? So there is a reason why you have those limits. And so it's actually really, really risky. We were able to come around on the accelerator by working with HCD to and again, credit to them for spending the time with us, to actually tailor all what we sign, what they sign at construction closing to make it as obvious as possible that there would not be conversion risk, meaning we know how they're going to convert, and ideally there will not be any surprise. Anybody who has worked with HCD will know what that means. When Lauren said they don't do construction financing, right, which we all wish they did, but we can discuss whether they can or cannot, but technically that's a reality right now. But what's very important, it means they do not completely underwrite at construction closing, right? That means they didn't really review everything. They did not sign off on everything. Where when suddenly you're at 100% loan to cost during construction and at 1,000% LTV, you're like, oh, actually, you're not going to tell me 2 months before converting that you don't like the relocation plan, right? Like, that's not acceptable risk. Like, you've got to sign off on this thing early on. So, again, great program, a whole lot of thinking with HCD on how to make it work, which hopefully be used on the next programs. Because, again, to get all the banks, or most of them, but again, we work on this collectively, to agree, like, we would be okay with no investor, would be okay high LTV, that was a major undertaking. And just to one moment on the investor thing, the not having an investor is not just a question of LTV. It means you have a partner at the table if things go wrong, okay? That's technically we underwrite the developer, but we all know in affordable housing, we're also looking at the investor, right? If things go wrong, they will step in. Nobody wants that to happen, but that's the reality of how we look at those deals. So especially when you think about smaller developers, if suddenly you don't have an investor, well, that sounds very sad music. I didn't say anything that sad, I suppose. I think.
It's like the Oscars.
Wow.
That's your cue, Cecilia. You've been talking for too long.
Wow. Yeah, that's funny. So the message is on HCD to go back to the thing is like anybody who works in the industry should really spend some time really help everybody think about how could they be involved during construction, because it will solve a whole lot of issues, and it's not small details. And by the way, the only people making money by having this big bridge to HCD are the banks, right? We get much bigger construction on, and even the banks in their, collectiveness, if you want, are saying it would be great to get HCD to come in during construction. How? And making sure they don't make the draw process harder. That's a whole other conversation, but not having these huge bridges would be a benefit to everybody.
And I just want to comment on the HCD thing as well as kind of appetite from the lending community for the accelerator program. I think that our, again, going back to the scattered readiness deadlines on our, the kind of bread and butter, LIHTC, 4%, 9% deals, we have to make sure that there's human capacity for the lending community to take this on. And I'll tell you that if we, at US Bank, we are a direct investor and a lender. We're going to prioritize, I'd say, developments that we can bring kind of our best to a transaction, which is kind of our bread and butter affordable transactions, the 4%, 9% that include an investor. And when you have all of these deadlines stacked on top of each other, it's a choice. Like from a human capacity perspective, what are we going to have room for? So I do think that this is such a important conversation. Hopefully, folks are listening, that we have to go back to some type of scattered schedule for our closing dates for developers, for investors and lenders, because again, we're going to have a glut of deals just sitting and not having interested parties, not because we're not interested in it, because we don't have the capacity at our shops to get that done.
Right. So at the investor panel this morning, I don't know if any of you attended, but their advice was come to us as soon as 2 years out if you have a deal.
What?
2 years.
Yours is a little
Okay.
far.
So
we all wish, but yeah.
I think for you, it sounds like maybe the timeline's not 2 years, but how early is too early for a developer to come to you saying, listen, I intend to apply for, whether it's the 4 or the 9, and I have we think we have a really good shot. How early is too early?
Well, I think there are a couple of things wrapped up in that question. If you want a lender or perhaps multiple lenders to begin to plug in your deal into an underwriting tool, that's staff time. And if it's really far out and you feel like this is just a shopping exercise, it's not something that I would recommend that my team work on. But on the same hand, because we've got these great relationships with our clients, we are happy to have conversations about it. The things that are important to know are how many subsidy sources are you going to have on this? What kind of funkiness might exist in the deal? Can we talk about that in advance? If this is one that's going to be the first time you're seeing it, like an accelerator program, part of the why all the banks have been talking about the program with HCD is that we wanted to go back to our credit shops and say, hey, this is coming. Don't freak out. It doesn't look like anything you've seen before, but let's talk about how the risks are mitigated in the deals. You need to have some of that sort of leeway time to have that discussion. But I think what the investor panel was saying is that the days of just dropping off multiple RFPs and then giving people like 30 days to turn, or not even, like 2 weeks over a holiday probably, or a summer break, to turn around a response are kind of done. Like we're all maxed out, and it's better to kind of really figure out of your portfolio of projects, how do you shop them around for the best fit?
Yeah, I'll just add real quickly too. Because when we look at a loan at the front end for an acquisition loan, we kind of understand that pro forma is changing over the next 2 years. I mean, we just don't know how exactly the deal is going to look. It makes sense at the time based on the sources that we have today, but in 2 years from now, the world's going to look very different. So I don't know how much real work you can actually do for something like that.
I think you only it's really needed for like deals that have a major problem to deal with. That's probably when you want to invite everybody to the table early on. For the average deal, you don't need that. But I completely agree with Elizabeth on that one. The days of 5 deals coming in 5 days it's just ridiculous, right? And there's no value in it. Like there is that perception by doing an RFP, you're going to get much more amazing terms than if you don't. That's not actually true. And it might be better to say, okay, I want to show you this deal versus that one to save your time, because the bank is going to be really thankful for that. And we'll still put our best foot forward. We're not stupid. People can see the difference, right? Mm-hmm. But yeah, capacity is a major one. So we're passing deals for the first time ever.
All right, so no speed dating. Got it. Okay.
Hey, Lauren, could I comment on something?
Sure, Kenji.
So the conversation so far has been about mostly new tax credit deals, but on the permanent financing side, we face the same issues, capacity crunch, like on the third-party reports, for example. What we used to be able to get in 2 weeks is now taking 4, and what used to take 4 is taking 8, So the industry, as one of the other panelists said, is stressed overall. But when you're, and I'm skipping ahead a little bit, we're going to talk a little bit more about refinancing. But refinancing, especially in this day where it is so hard to get bond cap, and the QAP is really limits the opportunities to be competitive on re-syndications of existing deals, then refinancing really becomes maybe the only real option for deals where you have maturing loans, or you have a requirement to buy out. There's a real cost to buying out the limited partner, or you know that you're going to have some significant capital needs at a certain point of time. And in those cases, as a lender, we typically look at the previous 3 years of operations plus year to date. So if we were looking at a deal today, we'd be looking at 2019, 2020, 2021, and 2022 year to date, and looking at the trends and saying, how's the property operated over the last 3 years, and if it continues to operate the same way, what kind of permanent debt could this deal support? So if you have a property, if you're in year 10 or something, or year 11, and you know that there's going to be a buyout situation, you should be able to predict that based on capital accounts and maturity dates. You may not know whether you'll be able to get bonds at that point, but you probably have got a pretty good idea that something is going to need to happen. 4 or 5 years in advance is probably prudent, because if that property needs to have rents, if you run a quick calculation and you realize you're not going to be able to support the debt that you need, you may need to start looking at maybe making some adjustments to how you operate the property, your policies on rent increases, maybe trying to find ways of improving the property performance so that you are at where you want to be 3 years in advance of when the financing event will occur. And then when the financing event actually occurs, you now have 3 years of historical operations that you can show your lender. So it's a little bit of a different, the justification is really different than the talk to your lender 2 years in advance. But I think on the permanent financing, you do need to have that long-term perspective.
Great, thank you so much. I am going to move us on to the next topic. So again, those of you that were in the investor session this morning, we heard about modular from an investor's perspective. And full disclosure, I was on the board of one of the nonprofit developers who were doing modular construction, and there was no roof when we had a bomb cyclone. And as the investor said, it turned their modular project into a bathtub. So let's talk about bathtubs. We're going to start with Lisa, Eric, and Cecile.
Yeah, and we won't spend, I know there's some other hot topics here, and I know there's a full panel that Cecile's colleague is on tomorrow in regards, I think it's tomorrow, in regards to modular housing. But some of the lessons learned, we've done a few of these developments. I think really knowing I guess I'm speaking in terms of to developers who are considering this, knowing your modular partner, who you're going to be working with as far as a builder, as well as what is their connection, or how can you connect them properly with the GC that's going to be on the ground. We've seen a lot of kind of lessons learned with the GC not really kind of understanding the plans or understanding kind of the scope of work from the modular developer. So making sure those two are in lockstep are key. I think also really understanding from a building inspector and code requirement for modular housing in the jurisdiction that you're building in. There has been some surprises, in terms of requirements. So just kind of having a good relationship, I say good, relationship with local inspectors, I think is key, especially in a modular situation. I think, again, staying a step ahead of the subcontract agreement. There's various levels of agreements when it comes to the modular, the main contract as well as the subcontract, and then just how that all intertwines, again, with your general contractor on the deal. Engaging your lending and investing partners early. I can't stress that enough, because there are some things that we can either provide some guidance or and information in regards to lessons learned, but provide some insight on how the payments work, how draws work. Most of the time, draws are being funded without actual, with materials being stored off-site. and different inspectors, one on the ground, one at the modular component, as well as an escrow agreement, and then insurance and collateral. You know, a lot of this hinges upon wherever your modular builder is at and where the transport, how long that transport is, how that's going to be insured, as well as what is the bank's collateral, because we are, again, our funding for not really seeing, we're funding for improvements that are being done at a modular factory and not necessarily on the ground. So a lot of components when it comes to that. Also, I think site selection, really kind of understanding, I know that this is really early on, but some of the most interesting modular developments we've worked on are, you know, the various permits that are needed for city, county roads. You'd be amazed who controls the roads in a specific kind of small area, and you're going to be needing to transport large modular units down a street. So kind of understanding how that's going to be stored nearby, how that's going to be transported. It's just some components that we are thinking about.
Great. Eric, do you have anything to add?
Yeah, I would just say that Wells Fargo's had a couple modular projects that have unfortunately turned sour. One of those might have been that bomb cyclone that hit the Bay Area. You know, it's an atmospheric river with high wind and heavy rains. And one of the instances was a number of years ago, 3 or 4 years ago, where the modules had minimal weather protection. You know, there was kind of like a temporary roof, but maybe there wasn't as much in-depth thought about what could go wrong. And unfortunately, that protection was ripped off by the high winds, and there was significant water damage. Fast forward for a few years, I think there was a 2.0 type of shrink wrap wrapped around the modules. And unfortunately, another atmospheric river came this past fall, causing substantial interior damage. And, of course, none of the project timelines when we were underwriting and talking to the general contractor and the modular sub, were we considering delivering modules and stacking and threading them together during the rainy season. But that said, construction in a module factory is very linear. And, the project in front of you could hit delays. We talked a lot about labor and supply issues just a few minutes ago. So, pick your issue, particularly over the last 2 years with COVID, but pick your issue. And there's delays from a timing perspective. And all of a sudden, you're delivering modules that don't have maybe enough weather protection than they need. You're, as a sponsor or developer, you're 3 to 6 months behind schedule, and you just want to jam and get this thing up. You're behind schedule. Your cost savings that you had underwritten originally are kind of evaporating. So there's a lot of considerations there when these issues do happen. I think one potential solution could be, installing a more robust temporary roof that's actually within the original design. Obviously, you're adding a roof element that would then be removed at a later date. So it seems maybe unnecessary. It would drive costs up. And I know that we're all very sensitive to cost, given California and affordable housing is an expensive endeavor. But that might be something that we become interested in, to almost like an insurance policy, to avoid these major multi-million-dollar damages or issues that happen. In these two instances that I'm mentioning, insurance did cover the cost. However, their timing delays of engaging the insurance, bringing out their adjuster, actually extracting the cash and the capital from them. So there's a lot of money that developers or sponsors have to come out of pocket themselves to do some of the immediate repairs to get the ball rolling, and then have the insurance money come in maybe 3 to 6 months later. So a couple, I'm sure Cecile, you'll probably go in deep tomorrow on a couple of these, but there are timing delays that occur, and they do, I think the cost savings that modular construction advertises, it's tenuous if people are really capitalizing on those cost savings or not.
Thank you, Eric. So again, don't get whiplash, but we're going to change topics. Permanent supportive housing. Cecile, do you want to start? Maybe then Josh can go and.
Sure. So, like all of you, I'm sure we're doing a whole lot of permanent supportive housing project, which is fantastic. We all love those projects. We know they're very, very, very much needed, and we know it's good to see that there is so much support for them. What we have seen are a couple of things to pay attention to, I would say, like hearing a lot from developers about the way the coordinated entry system work and having high acuity case concentrated in project, which is actually creating some challenges with certainly vacancy because some other people don't want to live there. So something to really pay attention to in terms of working with a whole ecosystem around permanent supportive housing. And, you know, it's at the heart of it, what it is what we don't want is to see projects starting having problems and really scare, you know, the credit folks were like, wow, this is actually too risky. We were there like 15 years ago, and people don't remember how much work it took to convince all the financial institutions to get behind permanent supportive housing. So again, really paying attention to the ecosystem is really important. Other things, we see a lot of pressure on going to 20% AMI, 25% AMI. Well, 20% AMI, sure, great idea from our lovely public agencies, but when you see a whole lot of deals doing that, you're supposed to really underwrite how many people actually qualify. And you know what? At 20% AMI, there are a whole lot of people who don't, because if they get even just a part-time job or too many subsidies, blanking on the word, but you know what I'm trying to say, that actually create a challenge. And so we do know in some areas, and you will be surprised which ones, we can see a whole lot of problem with lease-up, where actually some developers have asked for help and saying, how do we work with CS to make it more, you know, working better? Because nobody likes it when the project don't fail. And it's not because there is no need. We all know that. Is the problem is the criteria got so narrow that it makes it actually really hard sometimes to fill the project, and it's to nobody's benefit. So I actually feel like at some point somebody needs to talk to those public agencies and say, no, we shouldn't have like so many units at that level. Give us more room. We know it's about scoring, so all the developers are pushed to do that. Many of them have actually not done their homework to check that population in their neighborhoods actually exists. So we're spending time saying, you have to tell us you have actually done your homework and you know they are there. We don't question the fact that they're homeless people. The problem is it's not the end of the conversation. They have to qualify for certain criteria. Other challenges, we see a whole lot of pressure on mixing populations. That's not new, we know that. But we're starting to see deal at 50-50, 50% homeless, 50% not homeless. There are markets where it makes sense, there are markets where it doesn't. And we know that. No matter how we want to frame it, when people have a choice about where they can live, they tend to pick a project where there is no homeless people in their building. That's actually the reality of it. If it's a small percentage, it's more likely to work. If it's a high percentage, people start asking questions. So then you have to make the case about design. Was the building well designed to accommodate two different types of population? And again, what's the market? Is it technically a market where people have fewer options, so they're going to go for it, even though that might not be their preference? All those conversations are really complex, and they cannot be ignored, even by people who actually do have shown that they want to support permanent supportive housing. And I would say the trends are a little bit worrisome on that, because we all, going and doing a lot more deals, but that means we're pushing aside a whole lot of questions we should be not ignoring. I have had some counties in some cities actually ask for our help to work with developers to make sure the developers are doing their homework. I have never seen that in 20 years. I won't say which cities and counties, but the big ones, right? And they say you need to tell people to actually pay attention, not just go for the scoring. And I would agree with that. So that's my big picture, but obviously loving the fact that there are so many deals. It's just being smart about it matters.
No, fair enough. I think that's definitely a valid concern, and you're absolutely right. I have seen projects where targeting at 15% AMI sounds like a good idea, but you have to do your homework. And if an SSI payment puts them over 15% AMI in that county, it's a problem. Yep. Josh, did you want to add?
I think Cecile really said it well, so I don't have a lot more to add, but and plus we're about 5 minutes left in the panel. For us, here's what we look at. We at the end of the day, we want to make sure that I think the partners are important. In the PSH deals that Century moves forward with are typically with people with a lot of experience in this space, who oftentimes provide their own social services or have partnerships with really strong organizations that do. And so for us, we're really looking at track record and making sure we're working with people who really understand that population well. We are absolutely not working with groups that see this as like a yield play. There are some, groups particularly in Los Angeles that are, building 100% PSH with the idea of, housing as many people as they can to take advantage of tenant-based vouchers, without really regard to the community that they're going to be going into or the services that are kind of embedded within that community. I think that's something that we have, traditionally shied away from.
One thing I would add on this, Union Bank actually has done quite a bit of permanent supportive housing, and I really applaud my colleagues in Southern California who I think really helped grow that practice area and the bank's comfort with it. Some things that we've looked at are recommending a higher contingency, I think partly to deal with just having that extra bit of cushion if there's going to be a delay in finding the right tenant population during lease up. Again, it kind of comes back to, do you have a realistic time frame for when you're going to want to convert the deal? Are you building in time for whatever process is going to have to be used in terms of matching tenants with the available units? I think you said it eloquently, Cecile, about just sort of the mixture of the populations and really being thoughtful about that. But I just wanted to make sure people were thinking about things about, again, cushion and how do you help a deal kind of weather some of the delays that are going to happen. Mm-hmm.
Yeah.
All right, so we are almost at the end, and I am going to give an opportunity, starting with Kenji, then Eric, Josh, Cecile, Elisa, and Elizabeth. You each get 1 minute. Mixed bag, your topic. You ready? All right, Kenji, what's your 1 minute?
My 1 minute? My 1 minute is to look at refinancing as a really important tool. We are doing, the inability to get tax credits has obviously been a big change, but on the other hand, we've done a lot of big cash out refinances and have been able to put deals on an approach that makes them sustainable off of their own cash flow and refinances. So it's a great portfolio management tool. So I encourage you in this environment to look at refinances as a way to improve the overall health of your organization and hopefully support your long-term mission of providing affordable housing.
Thank you, Kenji. Eric?
I'd say, highlight deal issues early and often, whether you're in the pre-development phase or, prior to conversion. Use industry professionals as a kind of a sounding board, ideas. We're kind of all as a team together trying to get as many shovels in the ground and residents isn't home. So, use the teamwork that's here and bring as many specialists to your side as possible as a sponsor to develop your affordable housing.
Thank you, Eric. Josh?
Well, I just want to highlight one thing that I'm really proud of that Century's been a part of. So in Los Angeles, we had Proposition HHH, which was a $1.2 billion bond that the city created to house homeless people. And we were really proud to say, we just tallied this up, that Century provided acquisition and early stage acquisition and pre-development financing for 25 of those HHH projects, totaling about $87 million. And so for us, it was a really, really important part of our mission at Century. I'm also happy to say that almost all of those have been paid back. There's like, and most of them actually are completed and have been to a number of ribbon cuttings. So we're really proud of that.
Great, thanks.
So a couple of thoughts on my end. Obviously, we've shown our commitment to deeply affordable deals. I think for our team, for JP Morgan Chase, we actually did last year more than we ever did by almost double, right? And we're on track this year to do another, 25 or 30% above that. So we're really proud of how we've supported the LIHTC and bond transactions. What I would say is, having been in this industry like all of you for a long time, what's sobering is like we don't seem to make a dent on the problem, no matter how many deals we do. It's quite discouraging, actually, and that's part of why we have been so supportive of the accelerator. It's not because we need more deal from my team, they're at capacity, but it was more like we need to encourage innovation and other approaches, because we'll never get to it with just bonds and credit. Yes, on bonds, we love some relief on the 50%, that's always a good thing, we need it. We spent some time with KLHFA, I did, to try to think about, recycle bonds. We want to support everything, but there's very, very few ways to assume that it will be enough. So encouraging people to start looking at deals that do not require investor, right? Again, we want to be at the table. What else can we do to collectively? We've been also looking at the missing middle part of it, the educator deals. I mean, you name it, right? If anything else, the industry has been very, very innovative, no matter how hard the last 2 years were. But I would encourage everybody to keep thinking outside the box, and we want to be there, all of us as financial institution, but clearly bonds and credits are not going to be enough, so we need new stuff.
Great, thank you. I'll start thinking.
All right, U.S. Bank has been committed to affordable housing for quite some time. We've been doing this business since 1988. So again, many years of working in this industry. We specialize in, I would say, highly complicated deals, whether it's historic adaptive reuse, deals that include both low-income housing tax credits and new markets, very highly supportive housing development and deeply supportive housing development. So I think if you have a complicated deal, bring it our way. I think that's something that we excel in. This is my call to action. I think a lot of us maybe have either fell into this affordable housing industry or maybe didn't actually self-select. And I think this is the time. We are, again, if I say it again, we're capacity constrained, and we need more individuals to kind of self-select into this industry, whether it's on the development side or the financial consultant capacity building side, lending and investing. So if you find a friend today and out and about, talk to them about affordable housing. I think, again, we're trying to find as many people. We have many people that are aging out of this industry as well, and we need new talent. So that's my call to action for affordable housing.
Okay, find a friend.
All right, with my 1 minute, I will say two things. One thing is, as you're hearing, the lenders are spending a lot of time working with the public sector, trying to help ensure that new programs that are rolled out are going to be more readily acceptable from sort of underwriting standards. It really helps to have the development community also speaking with the public sector, because I think we're going to need these 2 points of perspective weighing in to get change to happen. And then the other thing I'd say is that the accelerator deals, they're solving an immediate problem we have with bond capacity, and Union Bank would love to take a look at a few accelerator deals if you have them. We've looked at a few. I think we've been trying to figure out, which ones are going to be the right fit, but we've been on all the calls with Hcd. We're ready to do one of these. So if someone has one, send it our way. We'd like to take a look at it and talk to you.
All right, so I want to congratulate all of you here in the audience. You made it, and then there's still 95 people online. Wow. Either that or they forgot they were watching. But a huge shout out to our incredible panel. These are really, really smart, dedicated, and mission-driven professionals, and just having them here is quite the honor. So thank you. Thank you, everybody. This wraps up the first day of Housing California. Go outside. Beautiful weather. Enjoy.
Yeah.